Hello and welcome to this session. This is Professor Farhat. In this session, we're going to be looking at the famous accounting equation. I'm going to cover the accounting equation as you would cover it in a financial accounting or introductory course. So you don't need any prior background. I'm going to go ahead and break the accounting equation for you. And hopefully by the time you are done, you'll be good to go. This topic also could be used if you're studying for your CPA exam. This is basically basic. You need to know this if you're studying for your exam. As always, I would like to remind you to connect with me on LinkedIn if you haven't done so. YouTube is where you would need to subscribe. I have 1,600 plus accounting, auditing, finance, and tax lectures. I don't only cover financial accounting, I cover all these courses as well. Please like this recording if you like it. Share it with others. If you're benefiting from this recording, it means it might benefit other people. So share the wealth. On my website, farhatlectures.com, you will have access to additional resources if you're an accounting student or CPA candidate. PowerPoint, true, false, multiple choice, and 2,000 plus CPA questions. Check it out. It's an investment in your career, investment in your education. So let's take a look at the basic accounting equation. The basic accounting equation, and here's the equation. It states that assets are equal to liabilities plus equity. That's the accounting equation. Okay? Now, it's very important, very powerful equation, and once you understand the accounting equation, it's easier to always see the big picture, and that's why that's the first thing we teach in accounting. So now you're going to learn about basic concepts that you need to have a good understanding about, because it's going to help you throughout your accounting courses, throughout your accounting career. So most likely, there's a good chance this is the first time you are listening to this topic, or you never learned it before, and this is the first time you're going to learn it and learn it well. So let's get going. So the first term is assets. So you need to know what is an asset. Simply put, asset is a resource. Asset is a resource. Asset is a resource that will provide future benefit to the business. So that's basically what is an asset. And that's all what you need to know for now. It's a resource, or assets are resources. Resources that will provide future benefit for the business. So what does that mean? It means you have something. Now you don't have to own it. It's good if you own it, own or control. You don't have to own an asset. Let's think about the real world, or think about yourself personally. What could you have that will benefit you in the future? What could you own or control? Think about a car. If you own or control a car, if you could use the car, you can go to work. Do you have a computer? Do you have a cell phone? Okay, those are all assets. Now, we're not talking about personal assets, we're talking about business. Remember, when we do accounting from a business perspective. Now, that's what assets are. But the most important asset that you could have, or a company can have, and I'm hoping you are thinking about it, and that is cash. Cash in your pocket. If you have cash in your pocket, it's the best resource that will do anything, that will provide future benefit for you in any way, shape, or form. What can you do with cash? You can pay bills, you can pay your employees, you can buy supplies, you can pay dividend, which is some of the terms you may not understand now, but you can do anything. Cash is an asset. Think about land. If you own a piece of land, it's an asset. If you own or control a building, that's an asset. If you have office supplies, it's an asset. If you have car or vehicle, it's an asset. If you have truck, it's an asset. If you have a machinery, it's an asset. So notice all these that I named: cash, land, building, office supplies, truck, machinery, vehicle, car, all these items, they fit the definition of providing future benefit. You can use them in the business to get benefit. So that's basically what an asset is in a nutshell. And that's all what you need to know for now. Now, there are many other assets that we would learn about later, many other assets, but for the purpose of this session, just we need to know what an asset is. So that's what's an asset. So we are done with assets. Let's talk about liabilities. If you want to use one word for liabilities to make it easy, liabilities are debt. Now, what is a debt? Hopefully we are all familiar with that. You might have, hopefully we are not, but we are, okay? So you might have credit card debt. You might have student loan debt. You might have, hopefully not, personal loan that you took out. You might have a car loan. So notice you have debt or loans. Those are all liabilities. Now, what is a definition for a liability? Well, a liability is something, it's something that's gonna use up resources to settle. Simply put, liabilities, it's an obligation that will require the future sacrifice of assets, generally speaking cash. We need cash. We need to use cash to settle the obligation. So obligation that would require future sacrifice of an asset, usually cash. Liabilities, something happened in the past. Liabilities occur because something happened in the past. What do I mean by this? Think about it. When do you have a liability? Is when you did something in the past. Like what? You borrowed money. If you borrowed money in the past, you have a liability today that you have to pay in the future. So basically, a liability is today for something that happened in the past, and in the future you have to pay. So it has a past effect, a current effect, and a future effect. And once you pay it, it goes away. Once you pay the liability, it goes away. Now, we talked about personal liabilities like car loan, credit card debt, personal loan, student loan, so on and so forth. Now, for businesses or a mortgage for a house, for businesses, you do have also debt. Now, for the purpose of today, we're going to only cover two types of debts, just kind of illustrate the point. The two debts that we're going to be defining today for businesses are accounts payable. And what is accounts payable? Is when the company buys goods or services on account. What does that mean? It means when the company buys goods and services, when we buy inventory, when we buy supplies, when we hire someone to do some work for us, what we tell them we're going to pay you later. We're not going to pay you now. So the company buys those goods and services on account. On account means we don't pay now. If we don't pay now, we have a liability called accounts payable. We have another liability. It's called notes payable. And what is notes payable? Notes payable is a fancy word, for loan. So notes payable is a fancy word for a loan. And what is a loan? Is when the company borrow money. And the company always borrow money. Company borrows money. They always borrow money. Most companies, as far as I know, it's borrowing money is part of doing business. So those are two liabilities. Okay, that's what a liability is. Now we know what a liability is. We know what assets are. Let's see if we can determine what is an equity. So let's use some numbers to start to kind of explain equity here. Let's assume as a company, I have 200,000 worth of assets. So I have 200,000 worth of assets. And we know what assets are. We have all sorts of assets. And we have 200,000 worth of those, a list of many things. And we happen to have 80,000 of liabilities. We have 80,000 of liabilities. Now, can you complete this accounting equation? If I told you we have assets of 200, liabilities of 80, well, I can kind of find out my equity is 120. Why? Because if assets equal to liabilities and equity, you're telling me I have 80,000 of liabilities, therefore I can fairly assume my equity should be 120. Now let's rearrange this formula and make a little bit more sense of this equation. Another way to look at the equation is to say equity equal to assets minus liabilities. That's what equity equal to. If I rearrange the formula, simply put, if I say my equity is 120 equal to assets of 200,000 minus 80,000 of liabilities, all is fine and dandy. That's what equity is. So what does that mean? Well, another way to look at equity, we can call equity net assets. We can call equity on a personal level net worth. We can call equity residual value. All these words can be used for equity. Net asset means the difference between asset and your liabilities. Net worth means after you liquidate your asset and pay off your liabilities, you are left with 120. Residual value is what's left after you pay off your liabilities. Those are three words for equity, but that doesn't help us. So what is equity really? Well, equity is what's left in the company, the value of the company after you pay off your liabilities. The question becomes, we know how we can obtain assets, or we know how to obtain assets, how to obtain liabilities. If we borrow money, we have assets and liabilities. But what affects equity? So think about it, what can increase my net asset? What can increase my net worth? What can increase my residual value? What can increase my equity? Oh, well, let's think about it. There are four things that you need to be aware of. Four things you need to be familiar with. Four things we need to be familiar with. Those four, two of those four will increase equity. Okay? And two of them, they would reduce equity. So we need to know about the account that increases equity and the account that reduces equity. So now we are working only with equity. We're only working with this part of the equation. What are those two things that increase equity and the two things that reduce equity? Well, think about it for a moment. If you want to increase your net worth, if you want to have more assets than liabilities, what would you do? Well, I need to get more assets without increasing my liabilities. What can I do? How can I get more assets? Well, guess what? If I get a second job or a better job, or if I can generate more income for myself, I can increase my assets without increasing my liabilities. So, what do we call this? We call this a new term called revenues. What is a revenue? A revenue is what the company does to generate more assets. Each company does something different. For example, your university where you are attending generate income by tuition. So they charge you tuition and that's their revenue. If you go on Amazon.com and you buy, that's sales for Amazon. If you go to your local shop and you buy something from your local shop, that's sales revenue for your local shop. If you are, let's assume you are an engineer and someone hires you, then they pay you. That's your revenue, engineering revenue. So each individual, they'll have a different type of revenue. So revenue is what the company does to generate assets. What does on a day-to-day basis, that's what they do for a living. Basically what the company does for a living. So revenues increase equity. Now, that's good. So revenues are good. So let's look at something that decreases equity. What could decrease equity? Well, think about it. If you have a business, you're going to generate revenues. But as you're generating revenues, you're going to have to incur expenses. Well, what are expenses? Well, expenses reduces equity. Expenses reduces equity. Revenues increases equity. So what are expenses? Expenses is the cost to run your business. Cost to run your business. So no company can generate revenues without incurring expenses. It'll be great. It will be excellent. It will be excellent if I can just generate revenues without incurring expenses. For example, when I teach at the university, I have to drive my car over there. So yes, I am generating revenue, but I also have to pay for gasoline. I have to pay for parking. I have to pay for other expenditure. So those are expenses. For example, a company might have to pay for their utilities. They have to pay for their cell phone. They have to pay for the internet service. They have to pay for insurance. They have to pay for rent. So what is an expense? It's the cost to run the business. So that's the second item that affect equity. And it's kind of, think of it as the opposite of revenue. Now here's what we need to know about revenues and expenses. We have a formula that says if we take our revenues minus our expenses, it's going to give us the difference between those. It's going to give us net income, or net loss for that matter, net income. So that's the first thing I want you to learn, or loss. Simply put, if we have revenues of 80,000, expenses of 30,000, we have a net income of 50,000. And that's what net income is. Okay, net income is the difference between revenues and expenses. They are both equity account. Both revenue is equity and expenses are equity. One increases equity, the other one decreases equity. Now those are the two equity account. Now, I said there are four, so we have to look for the other two. Let's think about if you like a company. What can you do if you like a company? If you like a company, you can invest, you can contribute capital. So you can give the company money. So if you like my company, you would like, I like your company. Great. If you like my company, invest in my company. Give me money. Give the company money, and I'll give you shares in the company. So what we need to understand is we have something called contributed capital. Or we're going to see it, the account is called common stock. What is that account? Well, if you like a company, and this is going to increase equity, this is going to increase equity. So we already identified the two accounts that increase equity, revenue and common stock. What does the common stock represent? It represents how much the investors invested in the business. What does that mean? It means when the investors give you money, okay, they invest in your business. It means they want to be owners. If they want to be owners, they have to give you money. When they give you money, your assets go up. When they give you cash, and your common stock goes up. So that's another way to increase your equity, is to try to convince people to invest with you, to invest in your company, not invest in you. It's the company. Okay, that's what contributed capital is. Now, why would people invest in your company? So why would you like a company? Well, you like a company for one reason, is because the company is good. Good in a sense that it's making a profit, and when it makes that profit, they're going to give you part of the profit. So what's going to happen is this. We have another account that when they make a profit, let's go back to this, actually to this example. You remember this fictitious company here? They made 80,000 of revenues, 30,000 of expenses. The company made 50,000. Well, the company might decide to give 30,000 to the owners. When they give 30,000 to the owners, this is called, the term is called dividends. So we're going to say dividend 30,000. So they pay dividend of 30,000. Well, if they pay dividend of 30,000, it means they took the cash from the business and they gave it to the owners. Well, guess what? The equity of the business will go down. The equity of the business will go down. So when the company pays out dividend, the equity of the business will go down. Now, let's go back here and expand this a little bit further. Let's go back. So we made an income of 50,000. Then we paid dividend of 30,000. We paid dividend of 30,000. No reason why I'm putting in parentheses. What's left in the company is 20,000. Well, what's left after we pay out the dividend is called retained earnings. Retained earnings. It's what the company kept after they pay out the dividend. So the company made a profit of 50,000. They paid 30,000 in dividend. What they left is 20,000. So net income minus dividend is retained earning. But all of those, all these accounts, revenues, expenses, common stock, and dividend, they're all under the umbrella of equity. Now let's look at what we called the expanded accounting equation. I'm going to erase everything that's on the board. So let's look at the expanded accounting equation. Assets equal to liabilities minus equity, common stock minus dividend. So remember, equity. So now we have the umbrella of equity. Under equity, we have contributed capital, and contributed capital is common stock. Then we have revenues minus expenses. Remember, everything under equity here. Everything under equity. Revenues and expenses gives us net income. And remember what we were doing. We said revenues are 80, expenses are 30. And for the purpose of our example, we had income of 50,000. Then we paid dividend of 30. I should have used a different number. That's fine. And what happened after we pay out the dividend, retained earning is 20. So notice, dividend, revenue, and expenses, they are all retained earnings account. Then we have common stock. So simply put, all in all, equity is composed of contributed capital, 1, retained earnings, 2. Now, retained earnings can be broken down further into revenues minus expenses, which is net income minus dividend, equal to retained earnings. So this is basically the expanded accounting equation. Now, the only reason you're going to learn how to do this is to first understand the big picture. And what we're going to do in the next session, we are going to analyze business transaction using this accounting equation. Now, as always, I would like to invite you to connect with me. Also, like this video if you like it, share it. Please visit my website if you're looking for additional resources and serious about your accounting education, especially if you're studying for your CPA exam. Study hard, good luck, and like the videos and share them. If they benefit you, it might mean they might benefit other people. Good luck.